Hi there, we are students from Bachelor of Real Estate, we're honest. Today we're going to present this particular subject, the SPS Literature, Property Finance and Accounting, about these interpretations of financial statement. There are four members of the Lam, Law, and me. And Dr. Muhammad Isami will be our lecturer, will always guide us. And there are two particular companies. Company A will be the company, and the company B will be the comparison company. Okay, next. Okay, here's some introduction about these two particular companies. Company A is Regional Engineering, Property and Infrastructure, established in 1976 based in Malaysia. They lead the region in innovative breakthrough solutions for large-scale public infrastructure and property development. Company A operates in 9 different countries such as Singapore, Vietnam, and Australia with over 6,000 employees. Company A focuses on engineering and construction, E&C, and infrastructure development industry, for instance, railway and MRT systems such as Glengarry Mass Rapid Transit and MRT Putrajaya Line. Next. Okay, the Company B is Malaysian Independent Builder conglomerate founded in 1974. The group is started as a small hardware shop in Nusa Kedah, has grown on into a corporate group with nationwide operation. The core business of Company B include the manufacturing and distribution of building material, construction, engineering, services, and property development. It delivers a comprehensive solution for the construction sector, such as a main supplier to supply essential construction materials such as cement, brick, and tiles to a development project. For property development, it focuses on residential and mixed-use projects, including down KLCC, Bandar Kirana. Company B shows strong business portfolio development industry for long-term growth. Okay, the next one. This is the methodology about our assignment. Methodology shows analysis of data resources by approach to collect, process to analyze the data with financial ratio calculation by using annual reports and audited financial statement. Structural methodology ensure that the analysis is both credible and reliable in order to obtain the strength, weaknesses, opportunity, and threat with two major companies. Okay, financial ratios are crucial to analyze and evaluate a company's financial performance ability. It shows the company's strengths and weaknesses. There are four types of ratios: probability ratios, equity ratios, efficiency ratio, and leverage ratio. Next one. Okay, there are four financial ratios. Okay, the probability ratio measure a company's operation, indicates strong management performance and a better financial health. These include net profit margin and return on equity. For the second one, the equity ratio measure a company's ability to meet its short-term financial obligations using its short-term assets. For the third one, the efficiency ratio measure a company uses its assets and resources to generate revenue. It's good for companies to minimize risks by managing resources wisely. Okay, the last one is leverage ratio. The leverage ratio, known as gearing ratio, it averages company's long-term financial stability and relying on debt financing. A balanced level of leverage shows a balanced financial risk. Okay, that's all for my part. Thank you.
Now I will present financial statement overview. These two tables shows the financial summary of Company A and financial summary of Company B. These two tables contain of revenue, net profit, and total assets. Next. First, the first one is revenue performance trend analysis. Company A shows moderate growth from year 2020 to 2022. However, its revenue then skyrocketed, more than doubling from 4.9 billion in 2022 to over 13.3 billion in year 2024. This dramatic shift is not typical of organic growth and strongly suggests the impact of major project milestones, large-scale M&A activity on the consolidation of a significant new business segment during this period. While the comparison company presents a classic picture of strong, consistent, and organic growth. Revenue climbs steadily every single year from 968 million in year 2020 to 2.32 billion in year 2024. This indicates a reliable expansion of its core business operation and market share without the extreme jumps seen in Company A. Next. The next one is net profit trend analysis. For Company A, its profit trend is highly related and project-driven. We see healthy growth from year 2020 to 2022. Then in 2023, net profit peaks dramatically in 2 billion, likely aligning with the recognition of profits from those major projects, driving its revenue surge. However, in 2024, profits fall sharply by over 50% to 947 million. This roller coaster pattern highlights companies' exposure to cyclical earning and the lumpiness of large infrastructure project profit, where competition phases can create peaks and top. For comparison company, again shows a stable and impressive upward trajectory. Net profit grew 13-fold over the 5 years, from 60.9 million to 250.5 million without any decline. This demonstrates not just top-line growth, but also effective management, scalability, and sustainable profitability in this operation. Next. The last one is total asset growth trend analysis. For Company A, its asset base is massive, reflecting its size. Growth was steady but saw a significant acceleration from year 2022 onwards, mirroring its revenue trend. Total asset grew from 20.3 billion in year 2022 to 6.7 billion in 2024. This expansion in asset supports the narrative of major investment, calculation, or capital-intensive project development during this phase, while the comparison company shows remarkable and consistent asset growth, more than quadrupling from 1.07 billion to 4.47 billion. This indicates aggressive reinvestment into the business, likely in property stocks, construction equipment, or strategic investment to fuel its ongoing expansion and strengthen its financial capacity. Next. That's all for my part.
Now come to the interpretation of financial statement for target companies. First, let us look at target companies' liquidity ratio, which reflect the company's ability to meet short-term obligations. Target companies' current ratio increased from 1.62 in 2020 to 2.21 in 2021, showing a strong recovery after the COVID-19 disruptions. The ratio remained above 2 for the following years, peaking at 2.23 in 2023 before slightly declining to 2.14 in 2024. This indicates that target company consistently maintain sufficient current assets to cover its short-term liabilities. Similarly, the ratio improved from 1.46 in 2020 to 2.03 in 2021, showing stronger liquid asset management. It experienced a small decline in 2022, but rose again to 2.13 in 2023 before slightly decreasing to 2.06 in 2024. Overall, target company maintained a strong liquidity position throughout the period. Next, we evaluate target company's profitability ratio. Target company's profit margin increased significantly from 11.71% in 2020 to 19.34% in 2021. reflecting improved construction activity and better project execution. However, it declined to 17.05% in 2022 due to rising material and operating costs. In 2023, profit margin reached its highest level at 24.39%, indicating exceptional profitability, mainly from high-margin infrastructure and overseas projects. Unfortunately, the profit margin fell sharply to 7.07% in 2024, reflecting higher operating and financing costs. The return on equity, or ROE, show a similar pattern. It rose steadily from 4.92% in 2020 to 18.93% in 2023, indicating efficient use of shareholders' funds. However, ROE declined to 8.40% in 2024 due to lower profitability from newly secured projects. Next. Now let's move on to efficiency ratio. Target companies' inventory turnover improved dramatically from 2.66 in 2020 to 16.86 in 2024, showing that inventory was covered into cost of sales much faster. Correspondingly, inventory days reduced significantly from 150 days in 2020 to only 20 days in 2024, reflecting highly efficient inventory management and faster project execution. Next. In addition, asset turnover increased from 0.20 in 2020 to 0.50 in 2024, indicating improved utilization of company assets to generate revenue. Target company also improved its cash collection efficiency. Receivable days decreased from 222 days in 2020 to 85 days in 2024, showing that customers pay much faster over time. Meanwhile, payable days reduced from 270 days to 162 days, reflecting better alignment of payment practice and improved working capital management. Lastly, SMI, that company's financial risk. Target companies' debt to equity ratio declined to 0.94 in 2021, showing conservative financing during the pandemic period. However, it increased steadily to 1.31 in 2024, indicating higher reliance on debt to fund new infrastructure and engineering projects. Higher borrowing. Target companies maintain healthy interest coverage. The ratio improved from 3.02 in 2020 to a peak of 11.51 in 2023, showing strong earning relative to interest expense. Although it declined to 5.45 in 2024, the ratio still indicates that company is able to comfortably meet its interest obligations. Now pass to next person.
So now I will talk about the comparison financial statements between target company and comparison company. So the first is comparison on current ratio. So this graph shows that target company's current ratio is significantly higher than comparisons for the current ratio and reflects stronger short-term liquidity in this period and the tighter liquidity and heavier reliance on the short-term financing. So the next is comparison on quick ratio. It shows that target company can comfortably settle short-term liabilities without selling inventory, but comparison company is below 1. It's indicating weaker short-term liquidity, so comparison company returning to a borderline liquidity position in the end of the period. The next is comparison on profit margin. So this graph shows that target company is more efficient in converting revenue into profit. Target company benefits from large-scale infrastructure project with better cost control and economies of scale. But at the end, both company narrowing the gap. So target company may have faced higher project costs, margin compression, or one-off expenses reducing profitability. So the next is comparison on return of equity. This graph indicates comparison company was more efficient in generating profits from shareholders' equity in 2022, while target company's ROE was relatively modest, possibly due to lower profitability or higher equity base during that year. So the next is comparison on inventory turnover. Target company's turnover remained low and relatively flat at the end of the study, so indicating continuous lower inventory movement, potentially due to prolonged property development cycles or cautious market demand. Besides that, we also studied about the comparison on asset turnover. Comparison company recorded a higher asset turnover than target company and showed that comparison company generated significantly more revenue per unit of asset than target company in the period. So the next is comparison on debt to equity. Comparison company again show higher leverage at the end, while target company continue a gradual increase in its debt of equity ratio. Target company's continued rise shows ongoing capital commitments and long-term investment. So the next is comparison on interest coverage. So this graph shows that target company performance dropped due to high interest expenses, project completion reducing the income. Then comparison company improvement shows that efficient debt management and improved cost control. So the next is inventory day. Both company inventory days dropped. This is because target company has strong cost control and minimal inventory holding. And for the comparison company also had gradual recovery in sales and better demand matching. So the next is receivable day. Comparison company receivable days decreased compared to previous years but still higher than target company. This is due to longer credit terms offered to customers in the construction and building material sector. So the last is payable day. This shows that comparison company experienced a further increase in payable days, suggesting greater reliance on trade credit to support operations, possibly due to rising costs or efforts to preserve cash in competitive market. So I'll pass to the next person.
Okay, for the conclusion, by comparing these two companies from credible and reliable sources of the annual report, the last 5 years, the 2020 to 2024, this data ratio shows a comprehensive picture of each company's financial performance and stability. No matter in economic conditions or role in industry, it can reflect the different strategic position they've taken. Overall, target companies stand out as a leader in infrastructure with strong engineering capabilities and focus on the long-term projects. In contrast, comparison company excel as major supplier of construction materials, supported by vertical integrations and complementary property projects. Despite their different business focuses, both companies have very important roles in Malaysian construction ecosystem and show how diverse strategy can lead to sustainable growth within the industry. We hope that these all financial calculations can help everyone. Thank you.